Hello guys, welcome to another video. Today we are going to focus on retirement of a partner, specifically in terms of partnership accounts. So this is where a partner retires sometime in between a year, maybe 6 months after a year started or 3 months, but the most common scenario for Kasneb questions for your level will be 6 months. So the question in particular we are going to look at is November 2020, question 3. And it says as follows: Lydia, Mercy and Priska have been in a partnership sharing profits and losses in the ratio of 2:1:1 respectively, after charging interest on capital at the rate of 10% per annum. Their financial year ends on that 1st of March each year. So meaning if it ends on that 1st of March each year, it starts on 1st of April each year. We are reporting it as at that 1st of March 2020. So start date is that 1st of March 2020, not that 1st of March, 1st of April 2019. That's the date we are reporting, the start date of this reporting. I have to format that into a date 1st of April 2019. So that's the start date. Then when did this partner retire? Priska retired from the partnership on 30th September 2019. Retirement date of Priska, it is 30th of September 2019. September 30th 2019. I have to format this cell first into the general format. 30th of September 2019. Then end of the period, end date. The end date is 31st of March 2020. 31st of March 2020. So that's the end date. So let's see the duration in between the start and the retirement. Excel actually can do the difference between dates. You simply select the date and you deduct it. You get 182 days, which is essentially half a year. The same for this other duration. It's exactly around half, because when you add the two it becomes 365. So let's say 6 months in is when Priska retired. So she retired 6 months into the partnership. So what we are going to do in columnar format, we are going to have two periods and the total. So I can prepare that as we go on, so that we can start capturing this information. So it's Lydia, Mercy and Priska. Is it a statement of profit or loss or just an appropriation account? Yes, profit or loss and appropriation account in columnar form. Statement of profit and loss and appropriation account in columnar form. For the two, there are two durations here. For the two periods ended those dates, 30th September 2019 and the 1st March 2020. The two periods ended 30th September 2019 and 31st of March 2020. So those two periods we are going to prepare in columnar form. So first of all, let me merge these cells, then I can develop a good column format. So we have for the first 6 months here. Then the next 6 months. And then the total. It's essential to have the total for reporting to the statement of financial position. So we can create a border here from that specific place. Yes, don't go so far down. Then another border around here, then border for the total. Around there. That's okay. Then it will be shillings in thousands. Is it in thousands? Yes, we are going to use it in thousands. The shillings in thousands. But first of all, let me format here in a better way. So this first 6 months, I can bring it to the top. The same for this one, to the top here. The same for our total here, to the top. Then of course I can merge these ones as well to be centralized for a better presentation. Yes, that's okay. Shillings in thousands, then I can copy these ones all through. And that will be now okay. Then when I select these ones, I want them to fit to the cells. So like that, so it's okay. So now we can start because we have the duration. The first 6 months, that is from 1st of April 2019. 1st of April 2019 to 30th of September 2020. Those are the first 6 months. You can write September in short form. The next 6 months is from 1st of October 2019 to 31st of March 2020. Yeah, those are the durations. Then the total. So let's go to our information now. We've established that Priska retired half during the year at a point in time where it was exactly half of the year. So she retired from the partnership, and Lydia and Mercy agreed to continue with the partnership and to share profits and losses in the ratio of 3:2 after charging interest on capital of 10% per annum. So it's still going to remain the same in terms of interest on capital. Then for the purpose of retirement, Priska from the partnership, the land was revalued to 20 million, equipment was revalued to 12. Goodwill was introduced into the partnership but was to be written off immediately. Priska agreed to leave the amount due to her in respect of her capital as a loan, which was earning an interest of 10% per annum, and the amount due to her in respect of her current account was to be settled in full. Number 4, accounts receivable amounting to 2.4 from the sales made to a trader who was declared bankrupt and it requires to be written off. Then these are relevant adjustments that relate to these transactions. We have land and all those. So we start with what is relevant for the income statement. We have been given the net profit as 16,800, and I think they said it will accrue evenly throughout the year. So if it accrues evenly throughout the year, you will apportion it according to the 6 months for each of the durations. So net profit reported is 16,800. Net profit reported. it is 16,800, but that is for the whole year, the total for the year. So if it's equal to the durations, we'll apportion it equally. So 16,800 over 2 and 16,800 over 2. So that's the profit for the 6 months each of the durations. Then when you're given this net profit, you have to check for any expenses that you will adjust before you go to the appropriation account. For instance, we have one expense here. The expense is the accounts receivable, which are to be written off. Because the trader is declared bankrupt during the year, we have to write them off, and bad debts is an expense. So less bad debt expense. The total is 2,400. Equally, it will be apportioned to the 6 months. 2,400. So for the 6 months each, it will be 1,200 each. Over 2. It should be over 2. Okay, that's okay. Then we have something else we should account for. Priska, the amount she left to us as a loan, it was to be earning interest of 10% per annum. Since she retired 6 months after, we have to establish how much of her capital she left to us as a loan. So for that purpose, we have to create a capital account and account for all of these transactions before her retirement. So we call it partners capital account. Partners capital account. Partners capital account there. We have 3 partners: Lydia, Mercy, and Priska. These are in thousands as well. I can copy all of them to these other sets. Can also bring them to this other side and make them bold. Then out-of-it them. Then here we have Lydia, Mercy, and Priska. So recall, for a partnership account, the opening balance is always on the credit side. If you have any drawings, you debit this account. If you revalue upward, that is a revaluation gain, you debit. If it's a revaluation loss, you credit. If you introduce goodwill, you debit. If you write it off, you credit it. No, if you introduce goodwill, you credit it, and if you write it off, you debit it. So let's start with the balance brought forward. How much capital did they have at the beginning of the year? So Lydia had a capital of 8 million, Mercy 4, Priska 4 as well. So 8 million, 4 million, and 4 million. Those are the capitals. Then we revalued land to 20. So how much was land before? Land was 4 million shillings. It has been revalued upwards to 20, meaning we have a revaluation gain of 16 million. Revaluation gain on land, specifically on land, it has gained 16 million. I'm going to use it in thousands. So since the gain is 16, we have to apportion it to the partners in the old profit sharing ratio. That is just before Priska retired, in the ratio of 2:1:1. So you're going to do 2:1:1, that is like 2 over 4, a quarter and a quarter. So 2 over 4 of 16, a quarter of 16, and a quarter of 16 as well. So you get the valuation gain apportioned will be 8, 4, and 4. We also revalued equipment Equipment was revalued to 12 million. The value before was 8. So 8 till 12. The revaluation gain on equipment was 4 million. Revaluation gain on equipment. It was now 4 million. So 4 million equally, we are going to apportion it in the old profit sharing ratio. This will be a quarter of 4 and a quarter of 4 as well. So we have 2,000, 1,000 and 1,000. We have accounted for the revaluation. Then now, goodwill is to be introduced, 4 million shillings, but it is to be written off immediately. This is presumably from Priska. So goodwill introduced. She introduced 4 million as our capital, not our capital, sorry, as our goodwill. So you have to apportion it in the old profit sharing ratio. 4,000 times 204, a quarter times 4,000, equally a quarter times 4,000. You get 1,000. Then you immediately write it off, the same amount, but now when writing it off, you'll just write it off for the partners that are remaining. It's the same amount, yes, but you're writing it off in the new profit and loss sharing ratio, which is now 3:2 for Lydia and Mercy, because now Priska has retired. So 3:2, that is like 3/5 of 4,000. Then this other is 2/5 of 4,000. So that's all we have. We don't have any other thing relating to capital. Now we can get the balancing figure, but remember, the amount due to Priska won't be given to her. She's going to leave it to us as a loan, which will also be an non-current liability in our statement of financial position. So of course the greater side is this one. You can sum this up. Equally, that balance is like that. So our balance carry forward, which is now going to be reported to the SFP, and which we're also going to use to get our current, we are going to get our interest on capital for the next 6 months, because now after the terms have changed, equally our capital and interest on capital will have to change. So our balance carry forward is the difference between 20 and 2,400, 17,600. I can equally get the sum for these others from Excel. It's going to get the automatic sum. So this is 10,000 as well. So the balance carry forward should be 10 minus 16. I can highlight these ones in red and bold them. So for Priska, the balance carry forward should also be 10 as well. But now, she won't have a carry forward. What will be her carry forward will be this loan from Priska. She is going to give us her balance of capital as a loan, so that now when we add 10, we don't have a carry forward for Priska. So our loan is the balancing figure for Priska, which is now 10. So this is a loan for Priska now, which we are going to report as a non-current liability. We're going to report it as a non-current liability. So we've actually done the capital account while doing this working. So there's something else mentioned about her loan. So Priska agreed to leave the amount due to her in respect of her capital as a loan, earning an interest of 10% per annum. The amount due to her in respect of her current account was settled in full on that 1st of March. So she gave us a loan. So loan is 6 months to the reporting date. our interest on that loan is at 10%. So how much of loan interest are we going to charge to our income statement? So loan interest will be 10% of the principal amount, which I can now say is 10,000. Principal loan amount is 10,000. So our loan interest will be 10,000 times the interest rate. But now she left her loan in terms of our capital for only half of the duration of the year. So the loan interest will be 500. This will also be a current liability. Reason being, it's an accrual because we always pay interest at the end of the year. But now the 500 will be recorded for only 6 months as an expense. Remember, we still had our profit and loss account here. So less interest on loan. So there is no interest on loan for the first 6 months because Priska still was in the partnership. However, now for the next 6 months, we have some interest, and the total will be the sum of the two. So we don't have any other expense. We can now get our adjusted net profit. So that we can now appropriate it to the partners in respect of their profit and loss sharing ratios. So that's what we have, and that's what we have. Adjusted net profit, which I can bold to show that distinction. So that's our adjusted net profit. Till there we have accounted for every expense that should be accounted for. Then after that, what we normally do is we add any interest on drawings if availed, but in this case there is nothing availed on interest on drawings, so we go directly to interest on capital. So less interest on capital. We have 3 partners: Lydia, Mercy, and Priska. So for the first 6 months, we are going to use the old capital before these terms change. The old capital being 8, 4, and 4. And how much was the loan interest on capital? The interest on capital was at the rate of 10% per annum. So it's 8,000 times 10%, but for half of that year. This one will be 4,000 because her capital was 4, times a half of the year times 10% as well. Similar amount for Priska. 4,000 of her initial capital times a half times 10%, 200. So we sum that up, then we deduct it from the adjusted net profit. Then you get the adjusted net profit, you deduct this interest on capital. In this case I'm going to add because I indicated it as a negative. Then is there any salaries to partners? We also deduct any salaries to partners at this point. I have not seen anything mentioned with regards to salaries to partners. So if none is availed, what we have here is our balance of profit to be shared. Our balance of profit to be shared is this. So our share of profit now will be according to the old profit and loss sharing ratio. So Lydia, Mercy, and Priska, we're going to share it in the old profit and loss sharing ratio. This is our balance of profit to be shared. Then the share of profit is according to the ratio 2:1:1, so that is 2/4 of the 64. This will be a quarter of the 64, and this as well will be a quarter of the 64. So it's just apportioning because you should not remain with anything at the end of this duration. You are apportioning everything to the partners. So I'll do the negative sum so that now when I apportion it, we have 0 at the end, like so. So that is for the first 6 months. That is for the first 6 months. For the next 6 months, there is some change that occurred. The change that occurred was with respect to the interest on capital. So interest on capital, we still have 3 partners, Lydia, Mercy, and Priska, which I can now copy very fast because we have all that information. So Lydia's capital changed to, according to the capital account, it changed to 17,600. So 17,600 times 10% equally for half of that duration. You'll get the amount as 880. So it's as calculated it as like so. The same for Mercy. Mercy will be a half of that year times interest on capital is still at 10%, but her capital now has changed to 84. Okay, like that. Priska though no longer has capital, so she won't get any interest on capital. So this is Lydia, Mercy, and Priska here. I can now get their totals here. So the totals here for interest on capital is simply, I've copied it on the wrong area. So let me copy it at a better area. Like so. So that's okay now. That's okay now. So the total now, first of all, I can get so I've also done this wrong. I've copied it a cell above what should have been copied, so it's now right. Now I can get the sum for this one. This will be a negative sum, of course, because the balance of profit to be shared is now 54. Then the share of profit is only on 2 partners now. We have now 2 partners because Priska retired. So it's only Lydia and Mercy who are sharing this profit for the next 6 months. How much are they sharing though? They are going to share 54 in the ratio of 3:2. I can include Priska here, but her share for these 6 months will be 0. So Lydia's share will be 3/5 of 54. Mercy's share will be 2/5 of 54. Now when we sum this up, negative sum, of course, because we are deducting it, you get the same 54. When you apportion the whole amount, it results with a 0. So for Lydia here, capital should be the total of these 2. Okay, I've copied a cell above again. Let me adjust it to the right area. That's all right now. So it's the total of the first 6 months and the next 6 months, which I can simply drag to get the total for every partner. So we have a total for Priska even though she retired because of the first 6 months. She earned some interest on capital for the first 6 months. So this is the balance of profit to be shared, which should be the sum of this and this. Then the share of profit is now for 3 partners as well, because Priska still had some profit for the first 6 months before her retirement. So that share of profit, I won't do it there, I'll do it in this cell. It will be the total for the first 6 months and the next 6 months. I can drag it down, it will auto calculate it for me. Then you get the sum of this, of course the negative sum, because we are deducting it, we are apportioning this profit, and when we apportion this profit we are going to get a negative, not a negative, a 0 at the end, like so. So this is what was expected for the first part in terms of the profit and loss. The key thing is to know that you have to adjust any expenses that have not been accounted for. Case in point, for this case we had our bad debts and our interest on the loan that Priska left to us. Then this is total for the year. So that's the first part, which was to earn you 6 marks. Yes, it says earned you 6. Capital account, you've already done it here, which has earned us now 4. So you're now at 10 marks. You can also develop a current account in the same manner. Then the statement of financial position. So the current account deals with the current balances, any interest on loan we got, any interest on capital, and things like those. So I can adjust it and rub off anything that's not relevant to this one, like these revaluations, they are not relevant to this case. Goodwill is also not relevant to this case here, so I can rub them off entirely. Perfect. So what's our balances for the current account? This is not a capital account, this is now our current account. For the current account, this is part C of that question. So opening balances for current account is 1200, 800 and 800. 1200, 800 and 800. We have 1200, 800 and 800 here. That's our balance brought forward. Any interest on capital is brought to this side. Interest on capital is brought to this side. So our interest on capital, we get the totals. The totals, we determine them to be 1280, 620 and 200. 1280, 620 and 200. Of course, all of them in thousands. You can counter check them. 1280, 620 and 200. We also include our share of profits. For the whole year, the share of profit for the whole year. What we have is 6440, that's 760. 6440, that's 760. I don't know what has happened here. There is a misalignment. just a minute, I align it the way it should be. So this is 6440. I don't know what has happened to this cell. It keeps on popping up, but I'm going to fix it up right now. I can undo it until the place it started having some issues. So this is 6440, still has that issue. Share of profit, that issue still recurring. Yeah, now that's okay. Interest on capital here is 200 shillings. Okay, now our share of profit is 6440. That's 760 and 1600. Can I transpose them? Let me see. I think I can. I think it's possible to transpose them. Yeah, just a minute. I transpose them. No, it's impossible. So it's 6440 at 760 and 1600 shillings. So it's also, we are going to include our loan interest, because loan interest is due to Priska. She gave us a loan, she's entitled to the interest, and that loan interest is for 500 shillings. Do we have any drawings? Let's see. In case of any drawings, we indicate them on the debit side. Drawings are there, 944, 1216. Drawings 944, 1216, and the last one for Priska is 1440 shillings. Then there was a note made with regards to her interest, not her interest but her current account rather. The amount due to her in respect of her current account was settled in full on that 1st of March 2020. So any balancing figure on her account will not be carried forward. Instead, it will be given to her from our bank account. To be given to her from our bank account. So that's what we have. Then what's the balance that she is due to have? Because here we have our balance carry forwards, which are going to report, of course, to the SFP as well in the capital section. The difference between 8920 and these drawings here. Here, of course, it's also the difference between the two. But her, for Priska, she should not have any balance. Instead, whatever is a balancing figure should be bank. That is, it should be settled. Should be settled. So when you go to make our SFP, we are going to deduct the amount that is going to be settled towards a current account, which is 1660 shillings. We are going to indicate this one in the SFP, deducted from the current assets. So this is what we have: a current account, the capital account, the statement of profit and loss. So you can now comfortably prepare the statement of financial position. Now for the statement of financial position, it's always for just the whole duration. There is no apportioning because it's at a specific date. Lydia, Mercy, and Priska. Statement of financial position as at March 2020. So this is, in my opinion, it's the easiest part of these questions because they don't have so many adjustments. Not like the case of the statement of profit and loss and appropriation. For the statement of financial position, it's more or less clear and cut. You don't have to adjust so many things. Some even are not even adjusted at some point. So we have on non-current assets, which we had revalued. Recall we revalued our non-current assets. We revalued our land and buildings, not land and buildings, we revalued our land and our equipment. There's no depreciation that has been accounted for, but let's counter check. So we revalued our land to 20 and our equipment to 12. So we include the revalued amounts. We always take the revalued amounts. There are some accounts I should have opened either way to indicate the revaluation gain, but since I indicated it, is not as important for this case. We don't have any other non-current, so we can get that sum. Then we proceed on to the current accounts, not current accounts, rather the current assets, which always comprises of inventory. Inventory is always closing inventory. Accounts receivable, which you are going to adjust. We have our bank balance. In case of any prepayments, we also include them. But in this specific case, there is none. Let's see whether there is any. So first thing is our receivables, 7,600, but we wrote off 24, which were to be written off to bad debts. So the trader was declared bankrupt during the year. So you have to take 7,600 as our receivables. We deduct 24 because he was declared bankrupt during the year. So 76 minus 24. Then our closing inventory, I think we've been given inventory. We are going to assume it's closing because we started from net profit. So inventory is 96. Then for the bank balance, remember we had to settle the amount due to Priska in full in terms of our current account. So we have 56, and how much are we settling to her? We are going to settle for her this amount of 1660. So I auto deducted it and summed it up. Is there any other non-current asset? Let's see. In terms of the cash, there is none. So we can now get our total assets, which is the sum of the non-current and current assets. So we first sum this up, and then we sum up these two. This will be our total capital, not total capital, total assets. They are like that. Then we go to the section of capital and liabilities. We have our capital section. Capital balance. We have 3 individuals, Lydia. Not 3, we now have only 2 because Priska retired, so she's not part of the partnership anymore. So the amount due to Lydia in terms of our capital is 17,600. Mercy is 84. We get the total for these ones. Then we determine the amounts due to them in terms of their current account. Same scenario, only Lydia and Mercy have current account balances because Priska retired. So we are going to sum them up here first, then we get the total capital. For Priska, the amount due to her in terms of her current account is 79.76. For Mercy, the amount due to her is 87.84. So we get that total as well, which we are going to include here so that we can get the total capital. So that's what we get. So that's our total capital. We have non-current liabilities. So for non-current liabilities, what we have was the loan that Priska left to us in terms of her capital balance, the principal amount of 10,000 shillings. So that's what we have. Then our current account, our current liabilities section. For our liabilities, we only have accounts payable of 2,800 and accrued loan interest. Accounts payable of 2,800 and the accrual in terms of our loan interest. So the accrual in terms of our loan interest was only 500. So the sum of these is 33. We get our total capital and liabilities. From the look of things, we've made an error somewhere because the amounts went to balance, but we can backtrack and check where we omitted something. So the amount for the total capital and liabilities is 56,060. Total capital and liabilities. So there's an amount that either we had included that we shouldn't have included, or that we failed to include. So let's take a look. How much is the difference? First of all, it's quite a huge difference. We have a difference of 53.20. So we can backtrack our steps and see what we did wrong. I've actually seen the place we made an error. So it's in our current account here. In our current account, this is the amount due to Mercy, 5180, and then the total here, I forgot to adjust the total. It was supposed to be 5180. So her carrying amount is 3964, not the amount I had included. So now when I do like that, when I do that, I think everything will be alright. Let me see whether everything will be alright now. $51,240 but this here is 5740. So there is an issue. The issue that is arising is with regards to the amount due to Priska. The amount due to Priska is supposed to be the difference in her capital, not in her capital, in the current account. Oh, I know what I did again. I forgot to include, no, I included the drawings due to Priska. Then I included the loan interest due to her of 500. So 1660 should have been deducted from my bank balance of 5600. So 5600 minus 1660 minus 1660 should be 3940. So the 500 shillings in terms of her interest, that's where the issue is arising from. That's where the issue is arising from. Let me see what that statement means again. She agreed to leave the amount due to her in respect of her capital as a loan, which earned interest on that percentage. The amount due to her in respect of her current account was settled in full on that 1st of March 2020. So it was settled in full on that 1st of March 2020. And if it was settled in full, it would mean that that's the amount we are going to settle in terms of her interest. Oh, we are not yet including, I included it wrongly here, because if you are settling her amount, we should not include it in this current account because it won't exist anymore. So we are settling it here in terms of this balance. Yes, so we are not going to include the amount of interest to her here. We are going to omit it for her like that, so that now the balance changes. So now here for our bank balance, now it's going to be minus this new adjusted amount of how much is this? 1160. So that now the balancing figures tally as like so. Yes, so that's how we do retirement of partnerships. In case of any queries, you can always reach out to me through the provided contacts on my channel. We meet in the next video now. Always remember to like, subscribe, and share this video. Tell a friend to tell a friend. Thank you and have a great time.